Well, hello and welcome to another episode of MMTed Q&A. Thanks for joining us, and thanks to all of those who keep submitting questions. We're trying to get to them as best we can. Tonight, my special guest is Warren Mosler, and I caught up with him from St Croix in the Virgin Islands. Okay, so Warren, here's our first question. It's from Chloe, and I believe Chloe is in New Zealand. And it's a long question, but I'll summarise it. Mainstream economists often say that bond financing of government deficits is less inflationary than overt monetary financing, as it reduces liquidity and the ability to spend. And so she really wants to know, why is it true that OMF is no more potentially inflationary than bond financing today?
The answer first, number one, it isn't. So let's look at what each one is. So we know government spends first and does that by crediting people's accounts. They just put money in your bank account. And they either leave it in your bank account, that's called monetary financing, or they allow you to shift it to a different bank account called a treasury security that pays interest. And they're both what you would casually call money. They are both dollars in bank accounts. So like if you have a normal commercial bank and you can put dollars in checking account or savings account, that doesn't change inflation. If it was announced that some bank in New Zealand has gotten a lot of savings accounts and not a lot of checking accounts, would anybody change their inflation forecast? No, it's still money put in by people. Now, what we have, fortunately now, is 30 years of proof from Japan and 10 years from the US and for Europe, where the central banks have gone in and shifted the money from the savings accounts, the treasury securities, back to the reserve accounts, the checking accounts. So they're taking your money out of your savings account, put it back in your checking account in vast size. Japan's been doing it for 30 years because they thought this would cause inflation, because they were under their inflation targets. They wanted more inflation, they wanted more economy. So they did it. They basically took all the dollars, in your case, that had been, but the yen in Japan, that had been shifted from checking accounts to savings accounts, and put it all back into checking accounts and detected no difference. And that's over 30 years in Japan, 10 years in the US, 10 years and more maybe now in Europe. So some people have tried to correlate that to events. They say, oh, when they started doing this, the stock market went up. The money went into stocks. That's not true at all. Money just stayed in the bank, didn't go anywhere. Stocks went up for other reasons. Stocks have gone up for forever anyways.
To clarify that, how do you deal with that argument that, oh yes, it hasn't gone into the general price level, but and we're talking here about the large expansion of assets on the balance sheets of central banks, that's what we're talking about, and the corresponding entry into the bank reserves. How do you account for the argument, oh, it didn't go into generalized price level, inflation, it went into the stock market?
All right, well, Japan's been doing it for 30 years, and their stock market's half of what it was 30 years ago.
Yeah.
It hasn't seen any major asset price rally in Japan. I don't think anybody's claiming Europe's had any major asset price rally in housing or anything else. They're already down to negative. And even if there was some, most economists would say that that would be from the interest rate changes and not from the fact that it's in one account or another account, because both accounts pay interest now. The overnight account will pay the policy rate. Right now, the policy rates are zero, so they're not paying it. But they would say, oh, when they drop their policy rate from 1% to zero, there isn't any channel that anybody's ever detected, except for maybe a placebo effect, to show that whether the money is in one bank account or another bank account at the Federal Reserve makes any difference. They'll still argue the interest rate might make a difference, but I don't think anybody argues that it matters which account in the Bank of Japan, the Federal Reserve Bank, or the European Central Bank. It doesn't matter which account, the euro, the dollars, or the yen.
What they argue is that, the central bank shifts the money from the debt accounts into the reserve accounts, and then the banks have all of those reserve accounts, and so they start speculating on share markets.
Right. So I owned a bank in the US for over 20 years.
Yeah.
You're not allowed to buy shares. Okay, it's just against the law. So no banks buy shares in the U.S. Japan they do, but not in the U.S. And in Japan, where the banks do buy shares, they haven't gone up. In the U.S., where they don't buy shares, they have gone up. If you get down to the details, they don't make any sense at all, because there were dire predictions when they first started doing this about hyperinflation and everything else. And none of that's happened. We got three major countries that have good data. You can go back and look at it and try and explain to me what you think happened.
I mean, what Chloe's trying to get at is the MMT position really is that there's no need to issue the debt.
Once the money is spent and it's put into your account, there's no need to offer you a different account. Let me just say one more thing about changes in interest rates. When you change interest rates, then interest rate sensitive things in the economy do change, if nothing else changed. So bond prices might go up or down, but they're just reflecting the interest rate. When any central bank changes rates, that's what they're doing. They're changing bond values. Now, the other thing is, look, the government, when a deficit spends, that money is going to be in bank accounts at the central bank, no matter what accounts they put it in. If they want the interest rate, the policy rate to be higher than zero, they're going to have to pay interest on all of, whether you call it the debt or you don't call it the debt, or Treasury securities count as debt, but bank reserves don't count as debt. Functionally, it's all the same thing. They're all government liabilities. And if they want a policy rate above zero, they have to pay interest to support the policy rate. I've all long proposed just to leave it at zero, which I consider the base case for analysis anyway, and the base case for determining asset prices, as Japan has demonstrated over 30 years.
Sure. Okay, Chloe, I hope that answers your question. Okay, that's it for tonight. Thanks very much for joining us. We'll be back next week with more questions and hopefully some more interesting answers. In closing, I just want to thank all of those who have made donations to MMTed so far. We really appreciate that and thank you. MMTed relies on public donations to build our capacity and to get us in a position where we can offer courses free of charge to the general public. We hope to start floating courses in September of this year. So if you can help, we really appreciate it. Thank you. Until next week, see you later.